Coming up today, tech shares continue to lead while others fall. The latest data on holiday spending. Are we going to get the Santa Claus rally? What to expect from AAPL this week? The latest theory on the New Jersey drone sightings. And has this massive divergence in the market reached the peak? Let's have a good week, guys. And a warm welcome back, everybody, to Daily Market Review. Hope you're doing well out there. My name's Jared, and every day after market close, I break down all the most important news, data, and charts to get you updated on everything happening across financial markets. And just before getting stuck in today, just a quick reminder, this is the last full week of trading for the year, as next week is Christmas week, where exchanges close early on Christmas Eve, closed all day Christmas Day, and trading typically slows down a lot. Low ranges, low volume, going into the new year. And so this will be the last week of Daily Market Reviews for this year. After this Friday close, I'm taking a bit of time off, and I'll be back on Wednesday, the 22nd of January, with regular scheduling of the Daily Market Review every day after close. And so just to give you the bird's eye view of what's going on in the market here and now, it's pretty much an extension on last week. We've got this continued run in tech shares and what you could call a bit of a K-shaped market, a massive divergence like I'm about to show you on the chart soon. However, as we can see, my reversal signals are firing off in the Qs here, meaning we could be getting a little bit stretched, and we're getting literally quite the opposite action in many other stocks and sectors out there. Look at the blue chips. Dow Jones Industrial Average down 8 consecutive days in a row. And what actually got really hit hard today was energy shares. Look at that, XLE off over 2%. Even though crude oil futures pretty much traded flat, just came off a little bit. So we've got a massive divergence between oil and oil stocks at the moment. And a big divergence between just most shares compared to tech stock. Just looking at a spread here of the Vanguard Total Stock Market Fund, kind of a broad representation of thousands of stocks out there versus the Qs. Very sharp sell-off. In fact, this whole candle is outside the buy-sell band, with the DSI at negative 18, proving we are currently in really oversold conditions here, looking at market breadth versus tech shares. We can also see that in the spread of value versus growth. Very oversold. We're getting some reversal signals firing off here, and kind of the theme this month, and in fact has been playing out a few weeks longer than that, is we're getting kind of this massive dispersion. Seen once again here today on the one-day sector performance chart. Discretionary tech leading, energy and healthcare and utilities, defensive sectors down the bottom, and just going out again to a 5-day chart. Over the last week, it becomes more pronounced. Going out to a 1-month chart, more pronounced again. And finally, just going out to a 3-month chart really shows how distinct this market's been trading of late, and what you could call a K-shaped market. A lot of dispersion, big divergence. Discretionary, communications, financials, and tech. Down the bottom, healthcare, REITs, materials, and staples and utilities. And so this could actually be laying the ground for a massive convergence at some point. I'd say next time we get a little upset in the market, a little surprise, a little spike in the VIX, we're going to see a lot of hot money come out of these growth sectors, and likely a pretty good bounce in the defensive sectors. And who knows, we may even get that this Wednesday if Jay Powell hints to the market that he's ready to go on hold. However, more on that in a minute. We can see that massive amount of dispersion looking at the one-day heat map. Still got mega cap tech well out in front here again today, although Nvidia's lagging. However, some of these other sectors are just continuing to get sold off at the moment, and I can see that looking across my own portfolios today. Some are up, some are down. That's why it always pays to combine different strategies for overall smoother performance. But the good thing is this is still a sign of a bull market rotation. When you see complete red across the map, even the mega cap techs are selling off hard. That's more of a pronounced bearish move. Indiscriminate selling, liquidation, everything getting sold off. However, like I've been saying, it's more the defensives lately, along with materials and energy continuing to get sold. And in fact, we've just gone 11 consecutive days of more stocks declining than advancing. We haven't seen that since 9/11 back in 2001. But the good news is we're now into the back half of December. That's typically one of the most bullish periods of the year for the stock market. We can see that in this seasonality chart. In fact, from this point on to the rest of the month, the market can easily add on 1.4%. However, NASDAQ has already done more than that. And so what we're looking for this week is maybe a bit of a catch-up from those lagging sectors, and maybe the Fed meeting and Jay Powell's presser could be the catalyst, along with PCE inflation this Friday as well. And just looking at the latest Deutsche Bank survey of portfolio managers, which, if any, of the following do you think pose the biggest risks to market stability next year? Please select up to 3. Out in front, and it wasn't even a concern this time last year, global trade war. Like I've been saying of late as well, I think tariff announcements and retaliatory actions from China could definitely give us a volatility episode come January, February, or March. Be kind of surprising just to see the market continually grind higher and low volatility all the way throughout Q1. Smooth sailing throughout the transition of power in the States, along with new policies, some of which we don't know exactly what they're going to be or how they're going to play out. Next in line, portfolio managers are worried about tech valuations plunging and the AI enthusiasm waning, followed by central banks hiking. Inflation proves more sticky than what we think. Bond yields rising more than expected. Middle East tensions escalating significantly. And you can see that big difference from December last year on a US hard landing. That was a big concern coming into this year. I would say probably 80-90% of people were convinced we were going into a recession this year, which now, as we're pretty much at the end of the year, has simply not played out. Also, pulling back on last year, liquidity crisis and private capital, high yield defaults, and commercial real estate. That was another big worry coming into this year. Many people were liking that to the next GFC. However, the Fed was well out in front of that. And if anything, it's bullish if it did spill over because it just gives them another reason to dump liquidity into the market. So anyway, this is a good playbook to reference over the coming months because if we see any bad headlines to do with global trade war, that's going to make a lot of portfolio managers nervous as they've labeled that their biggest concern along with tech valuations and inflation. So these are the most important themes as we head into 2025 we'll be keeping an eye on. Just got the latest research note from Goldman Sachs today on US holiday sales. Off to a healthy start. Hard data on Black Friday and Cyber Week spending indicate a healthy start to the holiday season. Black Friday weekend spending at online retailers rose 8.6% year over year, the fastest pace in 4 years. And just looking at spending at brick and mortar retails, which still make up 70% of retail sales, increased at a more modest pace. Taken together, we are forecasting 0.3% month over month, seasonally adjusted increase, forecasting a 0.5% increase in headline retail sales, reflecting lower gas prices but higher auto sales. So overall, the consumer's still out there spending and doing pretty good, especially online, which is probably helping the likes of Amazon trading up to all-time highs here, helping to take the consumer discretionary sector with it, for which it has a large weighting in, almost a quarter. So the consumer's still out there spending. Tech's already trading well, along with some discretionary stocks. Are we going to see a Santa Claus rally across the rest of the market? Bullish Brett. Well, like I said, we'll be paying attention to what Jay Powell says this Wednesday. I think that's going to play a role, along with PC inflation, as we head into this bullish seasonal period the last couple of weeks of the year. Certainly is fertile ground for a bit of a bounce. I am seeing a lot of technically oversold charts across many sectors. ExxonMobil, one of them, look at this, down 12% just over the last couple of weeks. Now sitting at a current level where we bounced back in early September. We do have a bit of bullish seasonality coming into the oil and gas sector here, and just looking at a spread chart of ExxonMobil versus crude oil, got some reversal signals here. Looking a bit technically oversold, so we are primed for a bit of a bounce here in these names, which all I would say is needed for that to happen is crude just to stay stable, maybe above its 50-day, and then just some other little spark or catalyst in the market just to change tune of things a bit. Because like I said, the NASDAQ itself is a little stretched as well. So what is the big kahuna going to tell us this Wednesday? He could be one and done. If I was Jay Powell, I'm not even sure if I'd cut this Wednesday. And this could be one of the quickest easing cycles we've ever seen because he may indeed be ready to go on pause. The economy is resilient. Consumer spending. Looking at market pricing. Quite a lot of froth in certain parts of the market. Even the Fed themselves think the US economy's grown at an annualized rate of 3.3%. That's hardly in dire need of stimulus. Quite far away from an emergency as well. And we just got more PMI readings today as well. Business is booming in the US services economy, which showed output growing at the sharpest rate since the reopening of the economy, COVID lockdowns in 21. The service sector expansion is helping drive overall growth in the economy to its fastest for nearly 3 years, consistent with GDP rising at an annualized rate of just over 3%. Different picture in manufacturing, where output is falling sharply at an increased rate, in part due to weak export demand. However, that could be changing a lot because we're getting a real pro-manufacturing administration coming in. But the US is mostly a services-driven economy. That's been the theme over the last couple of decades, is outsource the manufacturing and production of goods. Mexico, China, India. However, some of that is coming back. Not to mention the advances in high-end manufacturing. AI, robotics, definitely an important sector the states are looking to lead on. Already competing with China. Unfortunately, it's a bit of a different story around the rest of the developed world, where the UK and Europe's woes may not have hit a bottom yet. We just got a headline late last week. The United Kingdom stock market now trails Oman and Malaysia in IPO rankings. That's the amount of fresh capital being raised. How many new companies are going private to public? Also correlates with the level of innovation and sophistication of an economy and market. A healthy market and economy has a strong pipeline of IPOs along with investor appetite for them as well. It was only a bit over 100 years ago, United Kingdom was a dominant empire of the world, in which leaders from that little island pretty much settled half of the world by then, and along with other parts of Europe, laid the foundation of modern-day financial markets. It's unfortunate to report fundraising from London initial public offerings has declined about 9% this year to $1 billion, pushing the UK 4 spots lower to 20th place in a ranking of global IPO venues. And that's the thing with economics growth and prosperity. It all starts with capital. And like I remember Alan Greenspan saying once, if you want less of something, just tax it. And so the UK and Europe have done a pretty good job of that when it comes to their financial markets. Not to mention tons of red tape and regulations. It's no surprise we're seeing these other countries, Dubai, Asia, coming up and overtaking European countries one by one as they pretty much become an economic desert. But I guess unless the citizens vote for something different, then like I said, we may not have seen the bottom and how insignificant the UK and European markets are truly becoming. And there's another visualization of this as well. This is data right up until this month, in fact, comparing the 12-month forward price to earnings ratio of Europe, excluding the UK, relative to the States. Look at that discount, the widest we've ever seen, 40%. That's for good reason, because the States are simply growing their EPS so much stronger and longer than what European companies can. And so fundamentally speaking, it's hard to see this changing anytime soon, but I mean, how much further can this go on? And here's another way to look at it. 12-month forward PE of the S&P versus the rest of the world, the biggest gap we've ever seen. You can buy other developed country leading blue chip stocks 13, 14 times earnings. And so this is another ongoing theme we'll be monitoring next year, American exceptionalism in financial capital markets. And so we've got a bunch of sectors selling off. Coming into the election, healthcare was selling off hard. Then ever since United Healthcare CEO shooting, it's kind of been exacerbated, really shone a spotlight on the state of the US healthcare industry. In fact, the United Healthcare Group CEO came out with a heartfelt speech on the loss of his colleague, Brian Thompson, said America's health system is poorly designed. He's calling for reforms, said everything you'd expect a CEO to say publicly, showing sympathy for customers, many of whom, especially younger Americans, showing more support for the shooter than the victim's family. And that's because people are not dumb. They understand what's going on. They don't just believe everything that comes out of the CEO's mouth when in public, because on that same day, his colleague was gunned down. There's a video showing the same United Health CEO actually gloating about denying care, calling critics delusional. And I'm sure a lot of his customers would disagree with his statement that they make sure their care is safe, appropriate, and is delivered when people need it. I've seen heaps of stories in my social media feed, legitimate claims, if not being outright denied, been dragged on and on for months, in some cases for years, in which the customer actually has to hire a lawyer to get their health insurance company to pay out. And so it's kind of crazy to hear the CEO on the same day his colleague was killed, saying we're going to continue to do the work we do, says one thing in public, but then a completely different thing internally to some of his partners and employees. And the United Healthcare Group CEO, Andrew Whitty, is the highest paid US health insurer CEO. In fact, just last year alone, he received $23.5 million in total compensation. That's 352 times the median salary of a United Health employee. And he wonders why some people might think the system is broken. At the same time, they deny almost a third of all claims. And like one successful trader I've been following for a long time, Linda Rashke, just said a couple hours ago, I guess I was not alone in considering changing my healthcare plan away from UNH after it came out that they denied a third of all claims. Laugh out loud. And it's true, look at that. One would have to assume Luigi the killer might have actually achieved what he set out to achieve. He might have actually got caught on purpose to highlight his story with the US healthcare system. He got back surgery and rods inserted in his back, which wasn't done properly, didn't even look like he really needed, caused him a lot of chronic pain, amongst his other experiences with the US healthcare industry, with the stock now down almost 20% since that day, getting sold once again, down 4.2%, as probably more customers are actually cancelling with them instead, like I said, coming out in support of them, not to mention investors bailing on this. I mean, it's hard to see them squeezing their denial rate any higher after this, and on the back of a new government, we're likely to see some big reforms in the healthcare industry, not just insurance, but pharmaceutical drugs and the crap processed food that is now attributable to the leading causes of death these days. And this stuff happens all the time that most people are just not even aware about. For example, one that just came up on my feed recently, Johnson & Johnson, who regularly recalls their products. They add known carcinogens to their products, whether it's deodorant, sunscreen, baby powder, at the same time selling drugs that treat cancer actually caused by these products. So you buy one product from them that gives you cancer, then you go back to them and get another product to try and help with your cancer from that product to begin with. And that's the thing, most people see a large brand like Johnson & Johnson, they just automatically assume it's safe, it can be trusted. The good folks at the corporate headquarters have their health first and foremost in their minds, not their own profits. The fact is, you'll find a lot of these corporate executives from these companies and junk food companies, they don't even touch their own products because they know they're crap. They all eat local organic. Of course, it's a lot easier for them to do that. But my point is, the whole system's flawed. And since they've been getting away with it for so long, this could be an uphill battle for these big healthcare shareholders for years to come. If the industry truly does get cleaned up by the new admin, and it's not just the big drug stocks either, even the drugstore chain, CVS, getting slammed of late, as Trump along with RFK have already got many of these companies in their crosshairs. And so hopefully they can get the overall cost of healthcare for most Americans down. But as an investor, These are not stocks I want to be long. Could be years before they bottom out. But anyway, that's that part of the market. Like I said, there's still pockets of the market quite frothy. Quantum computing, once again today, look at this. QUBT, up 65%. D-Wave Quantum, 44%, 162 million shares traded. Quantum Corp, 29%. Rigetti, 17%. And so this is getting quite frothy. Can't go on forever. Some are starting to get reversal signals. And we may actually get the pullback or blow off top on these before Christmas or the New Year. I'll certainly be keeping an eye on them. But even the biggest of them as well, IonQ, 23% today. These are huge moves out there. Along with others, Soundtown AI, just casually slapping on another 16%, and a few others going for a run. Serve Robotics, 14.5% today. But even the biggest stocks out there, Tesla, I would say is getting a bit technically stretched here in the short term. Third reversal signal, up 6.1% today. Brand new all-time high. Market cap, $1.5 trillion for the first time. Even Alphabet Google trading pretty firm there on good volume. Got a nice bounce on drone companies today. Look at that, Red Cap up 26%. And that drone company, Don Trump Jr. joined the board of Unusual Machines, up 18% today. And speaking of drones, I'm sure many of you have heard a lot of mystery drone sightings on the east coast of America, around New Jersey, and apparently other parts of the country as well. Dozens of unidentified aircraft have been spotted over cities in the eastern United States. Some of the suspected drones have been flying over military bases and airports. The FBI has said it's still investigating, but doesn't believe they pose a threat. I heard some people on X speculating they're searching for a rogue nuke. Trump was supposed to go to Bedminster, his golf course, but that got rescheduled. Some people saying these drones are the size of a car or small bus. Others saying they're drones from Iran or China. Some people saying it's aliens because they can see them moving so quick with weird colors. But the one thing I've found funny with UFOs, and this kind of seems to be in the case over the last 80 years, is all footage of UFOs seems to be little more than 100 pixels. Very blurry images. We don't ever seem to get really high quality, clear shots of these UFOs. But we just heard from the incoming president, Trump claiming the military knows what the sightings are, but declining to comment if he had been briefed on intelligence. Said they aren't the enemy, and the government and the military know what is happening, but are keeping the public in suspense. He also posted this on his X, speculating these drones may indeed actually be McDonald's delivering burgers to Chris Christie in New Jersey there. I think is a plausible theory as well. But for sure, it does make for good online entertainment and memes. The stuff we're getting out there, certainly getting people speaking. There's RFK waiting in the shadows. There's another one, everyone driving in New Jersey right now, looking out in the sky to see what's going on up there. I mean, I have no idea what it is. We always get these reports from pilots at least. They say they constantly seen funny things in the sky. I think it's just the military testing out new stuff. And since it's quite sensitive, they don't really want to let on to the public exactly what's going on. Not to mention private companies and hobbyists, which I'm sure create their own drones as well. Pretty much anybody can these days. Get a drone kit from China in the mail. Because if you think about it, if aliens really are here, if they were smart enough to travel across the universe and get to us, I'm pretty sure they'd be smart enough not to be so easily discovered nor shot down. But anyway, that's just a little bit of entertainment to finish out the daily market review. Like I said, market's really quiet down around this time of year. Volatility and volume. You can see that in the VIX 9-day index. Option dealers just got it at 12. They're not expecting much movement in the market over the coming 2 weeks. Like I said, we'll be really paying attention to what Jay Powell tells us this Wednesday. Market's predicting he will cut 25 basis points. Is he going to hint that he's going on hold? And more importantly, how's the market going to react to that? And how much further can this divergence between most stocks and tech stocks go on for? Those are the themes we'll be watching for this week, along with PCE inflation on Friday. Otherwise, that's all I've got for you today. Thanks very much for tuning in, and I'll see you again this time tomorrow. Cheers.